Imagine this. Your hard-earned savings, your investments, everything you've worked for, is at risk. The economy is collapsing, markets are volatile, and the Federal Reserve has just announced another jumbo interest rate hike. The fear of recession is everywhere. But here's the good news. You can protect your money and even thrive during these turbulent times. Stick around, because in today's video, we're revealing proven strategies that will safeguard your finances when the economy is crashing. This isn't just about surviving a recession. This is about coming out stronger, smarter, and financially secure. Whether you're worried about your savings, your investments, or simply keeping your income intact, we've got you covered. So, how do you protect your money when the Fed goes big with interest rates? Let's break it down. What exactly happens during a recession? First, we need to understand what happens during a recession. A recession is a significant decline in economic activity that lasts for months or even years. In the US, it's typically defined as 2 consecutive quarters of negative GDP growth. But it's more than just numbers. It means higher unemployment, lower consumer spending, and, as we've seen recently, the Federal Reserve responding with aggressive interest rate hikes to try and curb inflation. In September 2024, the Federal Reserve is taking unprecedented action, increasing interest rates faster than at any point in recent history. These jumbo rate hikes have sent shockwaves through the financial markets, making borrowing more expensive, mortgages more unaffordable, and crushing the stock market. So, what does that mean for you? The real impact of jumbo rate hikes on your money: when the Fed raises interest rates, borrowing costs skyrocket. That means your credit card interest rates, mortgage rates, car loans, and any variable rate debt you have are all about to get more expensive. But it doesn't end there. Higher interest rates also mean that businesses will borrow and invest less, leading to lower economic growth, job cuts, and more uncertainty. Essentially, everything gets more expensive, and your money doesn't go as far as it used to. So, how do you protect yourself when the Fed goes jumbo with rate hikes? Let's jump into strategy number 1. Prioritize paying off high-interest debt. First up, prioritize paying off high-interest debt. During a recession, the cost of carrying debt can cripple your financial health. Credit cards, in particular, have variable interest rates that can rise in tandem with Fed rate hikes. What might have been a manageable balance could soon balloon into something much more difficult to handle. And trust me, the last thing you want during an economic downturn is to be stuck with massive debt that's compounding at a faster rate than your savings or investments. If you have any high-interest debt, whether it's credit cards, personal loans, or variable rate loans, make it your mission to eliminate or reduce these as fast as possible. Every dollar you spend on interest is a dollar that could have been saved or invested. Build up your emergency fund, now. Next, build up your emergency fund, right now. An emergency fund is your financial safety net, and in times of recession, you need that cushion more than ever. Unemployment tends to rise, unexpected expenses can crop up, and income streams can be more unstable. The general rule is to save 3-6 months' worth of living expenses in an easily accessible account. If you've already got some savings, try to boost it even more. Aim for closer to 9 months during turbulent times. Consider this. According to a recent survey, 44% of Americans wouldn't be able to cover a $400 emergency without borrowing or selling something. During a recession, that figure becomes even more alarming. Don't become a part of that statistic. Start padding your emergency fund today. Reevaluate your budget. Every dollar counts during a recession. Every dollar counts. Reevaluate your budget with a fine-tooth comb. Start by identifying any non-essential expenses. Do you really need that premium subscription? Can you switch to a cheaper phone plan? Do you need to dine out as often? Now is the time to be as frugal as possible. According to the Bureau of Labor Statistics, the average American household spends over $3,000 per year on dining out and entertainment alone. That's money you could be using to build your emergency fund or pay down debt. It's not about depriving yourself. It's about making sure your money is working for you during uncertain times. Invest wisely, even during a recession. Now, let's talk about your investments. The stock market can feel like a roller coaster during a recession. You might be tempted to pull out of the market altogether, but that could be a mistake. Historically, the market has always bounced back, even after the worst recessions. In fact, recessions can provide some of the best opportunities to buy high-quality stocks at discounted prices. Let's look at the numbers. After the 2008 financial crisis, the S&P 500 dropped over 50%, but those who held on saw the market recover and hit new highs just a few years later. If you had invested $1,000 at the market low in 2009, by 2019, that investment would have grown to over $3,200. But don't just throw your money at any stock. Focus on companies with strong balance sheets, low debt, and a proven ability to weather economic storms. And remember, diversification is key. Spread your investments across different industries and asset classes to minimize risk. Take advantage of higher interest rates for savings. Here's some good news: higher interest rates aren't all bad. If you've been keeping cash in a savings account, now is the time to shop around for high-yield savings accounts or certificates of deposit, CDs, that are offering better returns. The jumbo rate hikes by the Fed mean that interest rates on savings are going up, too. According to data from the FDIC, some online savings accounts are now offering interest rates as high as 4%, compared to the near-zero rates just a few years ago. This is an excellent opportunity to let your cash grow passively while still keeping it accessible for emergencies. Invest in yourself. Your best asset. Let's not forget one of the most important investments you can make: investing in yourself. In times of recession, job security becomes a major concern. By learning new skills, gaining certifications, or expanding your expertise in a growing field, you make yourself more valuable in the job market. During the 2008 financial crisis, unemployment spiked to nearly 10%. Those who had specialized skills or were adaptable to new roles were far more likely to find work and avoid the brunt of the downturn. Whether it's through online courses, certifications, or simply expanding your knowledge, investing in yourself pays dividends in any economy. Protect your income streams. Diversify. In a recession, your income could be at risk. That's why it's critical to diversify your income streams. Don't rely solely on your 9-to-5 job. Explore side gigs, freelance opportunities, or even passive income sources like rental properties or online businesses. If one income source dries up, you'll still have others to fall back on. According to Pew Research, nearly 36% of Americans now participate in the gig economy. By diversifying your income, you create a financial safety net for yourself, ensuring that you can weather any economic storm. Hedge against inflation. Gold, commodities, and real estate. With inflation soaring, you need to think about hedging against its impact. Traditional assets like cash can lose value over time, but investments in gold, commodities, and real estate tend to hold their value better during periods of inflation. During the stagflation of the 1970s, gold prices surged by over 700%. Real estate also proved to be a solid investment as property values rose with inflation. If you're concerned about the eroding value of your money, these alternative investments could offer a hedge against rising prices. Don't panic. Stay focused on long-term goals. Above all, don't panic. Recessions are scary, but they're also a natural part of the economic cycle. History has shown that markets recover, and those who stay focused on their long-term goals tend to come out stronger on the other side. Remember, recessions don't last forever. By staying calm, making smart financial decisions, and keeping your eyes on the future, you'll be in a much better position to protect your money and come out of the recession in a stronger financial position. Take action today. You now have the tools to protect your money in a recession. From paying off high-interest debt to investing in yourself and staying calm during the storm, these strategies will help you not just survive but thrive during tough economic times. Remember, the actions you take today will determine your financial future tomorrow. Thank you for watching. If you found this video helpful, make sure to hit that like button, subscribe to the channel, and share this video with anyone who needs to prepare for the tough times ahead. Stay strong, stay focused, and protect your financial future.